Something massive is happening in the silver market right now, and almost nobody's talking about it. What you're about to hear sounds impossible at first, but it's real. A single trader managed to short more silver than actually exists inside one of the world's major futures exchanges. Yes, more silver than the entire exchange holds. This isn't just another price swing. This is potentially one of the biggest silver market events in modern history. Today we're going to break down exactly what happened, why regulators stepped in, what it means for silver prices, and why the situation looks like a reverse Hunt Brothers moment. Except this time, someone tried to crash silver instead of squeeze it higher. Let's get into it. Before we even talk about silver, we need to understand the environment we're in. Markets are already under massive stress. Stocks recently experienced their worst single-day performance since the 1980s crash. At one point, major indexes were down over 40%. Economic analysts are openly discussing the possibility of the most serious recession in decades. At the same time, geopolitical tensions are rising globally, and major governments are issuing emergency advisories to their citizens abroad. Whenever this happens, investors historically move towards safe haven assets: gold, silver, hard assets. And that's exactly what we're seeing. But this time, silver has something else going on beneath the surface, something far bigger. Here's where things get wild. One trader built a short position in silver so large that it exceeded the entire physical inventory of a major Asian futures exchange. Let that sink in. The size of the short reached approximately 450 metric tons of silver, while the exchange itself held less than that. At one point, the short position represented over 107% of all available warehouse silver, and then, just days later, nearly the 20% of the remaining silver was physically removed from the exchange vaults. That pushed the short exposure to roughly 130% of total inventory. In other words, this was a naked short. There simply wasn't enough silver to cover it. Regulators immediately stepped in and froze the account. The trader can't exit or adjust the position for at least a month. And the entire world now knows about it. This wasn't handled quietly. Information about the position was intentionally leaked to financial media. Why? Because regulators wanted to send a message. They wanted maximum visibility. They wanted the market to see what happens when someone places outsized bets that threaten stability. This public exposure effectively turns the trader into a sitting target for market forces. Now, the pressure is on. If silver rises even modestly, this short position could experience catastrophic losses. The market itself may now inflict what traders call maximum pain. Back in 1980, the Hunt brothers famously tried to corner the silver market by going massively long. They pushed prices dramatically higher. Eventually, regulators intervened, margin rules changed, and silver collapsed. This situation is the mirror image. Instead of forcing silver higher, someone tried to crush it lower. Instead of going long, they went massively short. And once again, regulators stepped in. History doesn't repeat, but it often rhymes. Before the account was frozen, silver experienced a sudden flash crash. Prices dropped over 16%, with some markets seeing nearly 30% declines. That move reportedly generated hundreds of millions in profit for the short position. However, whether those gains can actually leave the country remains unclear. Regulators still control the situation, and now the position is locked. At the same time, Western exchanges raised margin requirements. Again, silver margins increased roughly 20%, gold margins rose about 10%. This marked the third margin hike in just 10 days. Why? Because volatility is completely out of control. We're seeing 10% daily moves in silver, something that used to be headline news. Now it's almost normal. Raising margins forces leveraged traders out and attempts to stabilize prices, but it also shows how unstable the system has become. Here's the bigger picture. Silver is flowing out of exchanges globally. Inventories are shrinking. Retail-ready silver is becoming harder to find. Industrial demand continues to rise, especially from solar panels, electronics, and EVs. Meanwhile, safe haven buying is accelerating. Some governments are even discussing building strategic stockpiles. This isn't speculation. This is physical metal leaving the system. And once physical silver is gone, paper contracts don't matter. Silver has already tested extreme levels recently. Some buyers paid over $120 an ounce. Yes, really. Many long-term holders remember buying silver under $20. So today's prices already feel surreal. But if supply continues shrinking and demand keeps rising, much higher prices are not unrealistic. $100 silver no longer sounds crazy. $150 is absolutely possible. And beyond that, nobody knows. But what we do know is this. The fundamentals haven't weakened. They've strengthened. We are witnessing something historic in real time. A massive naked short. Exchange inventories draining. Extreme volatility. Rising geopolitical risk. Multiple margin hikes. This is not normal market behavior. Silver is sending a message. Whether prices go up or down next week doesn't matter. The bigger story is that physical metal is disappearing. Trust in paper markets is eroding and pressure is building across the entire system. If another dip comes, many long-term buyers are ready, because this feels less like a trade and more like a monetary reset in slow motion. Let me know in the comments where you think silver goes from here. Thanks for watching. I'll see you in the next one. This is just information. You are responsible Yerdeshans.